Welcome to the Deep Dive. I want to kick things off today with a statement that really makes you think. It's from Michael Saylor. Bitcoin is either something or it's nothing.
Mm-hmm. A pretty stark binary.
Exactly. And when he first said that, it felt like this huge gamble, right? A bet on something totally unproven. But look where we are now. It's kind of astonishing, actually, that Bitcoin didn't just hang on. It recently blew past $118,000.
Yeah, a new all-time high. That's definitely not nothing.
Definitely not. It's a very loud something.
Mm.
It feels like its place is, well, pretty undeniable now.
It really does. I mean, reaching that level, it just changes the whole conversation, doesn't it? And that's our mission today, really, to give you a shortcut to understanding why this shift is so important.
Right.
We're going to dig into Saylor's vision, Bitcoin as digital capital, his, let's be honest, pretty mind-blowing projections, and also this surprising angle on volatility.
Yeah, that volatility piece is key. So we've done our homework, gone deep into a YouTube video with Saylor himself, pulled out the core ideas, what he calls the economic physics, without getting lost in the weeds or the jargon.
Exactly. This isn't just for the crypto heads. If you're curious about where finance is going, if you want to cut through the noise, this is for you. We're trying to get at the underlying forces here.
And we've got this really interesting take on risk versus volatility coming up that kind of flips conventional wisdom on its head.
Mm-hmm. And this idea of economic gravity, it might just change how you think about wealth itself, where it goes, why it moves.
Okay, let's dive in. First stop.
Yeah.
That something or nothing idea.
Yeah.
He was adamant it couldn't be halfway. It was either going to boom or bust completely.
Yeah.
What's his take now with these prices and institutions getting involved?
Well, his conviction hasn't just strengthened, it's solidified. He's now saying pretty unequivocally that the nothing scenario, Bitcoin going to zero, that's no longer realistic.
Okay, so off the table.
Completely off the table in his view. That recent high, over 118K, he sees it as, and I quote, irrefutable proof of its legitimacy as an institutional asset. He's basically saying the debate is over. Bitcoin's place as a global institutional asset is no longer up for debate.
Wow, that's a strong statement.
It is. And it's not just wishful thinking. It's based on the market performance, the big players getting involved, its sheer resilience over, more than a decade now? When major banks and funds start touching it, it's crossed a line.
Right. So if the nothing scenario, the fail case, is gone, then, as he puts it, the focus shifts entirely to the full upside still ahead.
Exactly.
That sounds incredibly optimistic. But why? Why is there still so much potential gain if it's already this established institutional asset?
Hasn't a lot of the growth already happened?
This is where it gets really interesting. He puts it down to a knowledge gap, a fundamental one.
Mm-hmm.
His argument is most of the world still doesn't understand Bitcoin.
Understand it in what way?
Yeah.
Not just technically, but its actual role, its purpose in the financial system. And he believes this lack of understanding, this is the key, is precisely why the biggest gains have yet to come.
Huh. So the ignorance is actually the opportunity.
In a way, yes. As more people, more institutions, even governments start to get it, to grasp its unique properties, well, the capital flow just continues, unlocking value the market hasn't priced in yet. Think of the early internet. Only a few saw the full potential then.
That makes sense. It's like this massive asset that's still kind of waiting for everyone else to catch up.
Yeah.
And he doesn't just leave it there, does he? He puts numbers on it, astronomical numbers. What's his actual long-term projection?
Yeah, he gets specific. He forecasts Bitcoin growing at an average of 29% per year, its ARR, or annualized rate of return, for the next 21 years.
29%.
Yeah.
Annually for 2 decades.
Yep. And if that holds, he calculates each Bitcoin could reach, wait for it, $13 million.
$13 million.
Per coin. That's the projection, making it, in his words, the most powerful financial asset on Earth. More powerful than gold, real estate, you name it, as a store of value.
Okay, hold on. 29% average sounds, well, almost unbelievable for such a long period. How does he justify that number? Where does the 29% come from?
It's based on looking back and looking forward. He points out that Bitcoin's actual growth has been way higher, around 60% per year, for quite a while now, like the last 4 years since MicroStrategy first bought, maybe even longer depending on how you measure.
Right, it has been growing incredibly fast.
But he doesn't expect that 60% rate to last forever. That's not sustainable. His forecast actually sees that rate slowing down, decelerating to about 20% a year over those 21 years.
Okay. So the 29% is like a blend. High growth at the start, then settling into still high but lower? growth?
Exactly. It's an average that factors in the early hypergrowth and the expected, let's say, maturation to a still very strong 20% annual return over the long haul. He sees that 20% as sort of the natural pull for capital, looking for the best place to sit.
Even decelerating, those numbers are still huge. It implies a fundamental shift in where wealth goes.
Yeah.
So who's driving this? Who's going to adopt it and push it towards these levels he's talking about?
He sees it coming in waves. First, there's company adoption, which we're already seeing, right? MicroStrategy is the obvious example, but others are putting Bitcoin on their balance sheets too, as a treasury asset, basically.
Okay, corporations. What's next?
The next really big wave, he thinks, is institutional adoption. And we're just seeing the start of this. Pension funds dipping their toes in.
Pension funds. Wow, they're usually super conservative.
Exactly. That's why it's such a big signal. If they start allocating even small amounts, that's trillions potentially moving. He expects big university endowments, those nonprofit 501c3s, major insurance companies they'll follow. They all manage huge pools of long-term capital.
And why would these big, cautious institutions jump in? What's the core appeal for them?
It boils down to something pretty basic, actually. They have capital, right,
Hmm.
lots of it. And they all want to either keep their money safe or, ideally, get more money.
Makes sense.
In a world with inflation chewing away at value and bonds maybe not offering much real return, Bitcoin starts to look like a potential solution, especially for preserving wealth over decades. It's like finding a better battery to store economic energy.
Okay, companies, institutions. What else?
The final piece, potentially the biggest, is nation-state adoption. He makes this striking point that the U.S. government already holds, I think he said about 1% of the Bitcoin ever mined, mostly from seizures.
Right, from criminal cases and things.
Yeah, and his point is, if they just hold it, don't sell it, that's huge. It's like a tacit endorsement. He also mentions political wind shifting, citing Donald Trump saying, never sell your Bitcoin as a positive sign for broader acceptance, maybe even strategic buying by countries down the line.
Interesting. So it sounds like he's drawing a really clear line between different kinds of money. He keeps using this phrase, digital capital, for Bitcoin. Can you break that down? What's the difference between currency and capital in his view?
Yes, this is absolutely crucial to his whole argument. He says that money, as we usually think of it, isn't just one thing anymore. It's split. It decomposes into two parts, currency and capital.
Okay, so currency first. What defines that for him?
Currency is your medium of exchange. Your dollars, euros, yen, stuff you use day to day. It's legal tender. You can swap it easily without tax hits. Usually it's liquid, fungible. $1 is like any other dollar. You pay taxes with it. Things are priced in it.
Got it, like cash or money in your bank account.
Exactly. And he makes a really important point. The dollar is still the world reserve currency, and he actually thinks it's getting stronger, not weaker. He's not saying Bitcoin replaces the dollar for buying coffee tomorrow. That's not its role.
Right, so currency is for spending. What about the other piece, capital? What is that traditionally, and what are its problems?
Capital is the store of value side of money. It's the liquid, fungible asset you use to preserve wealth, maybe pass it down generations. For ages, gold was pretty much it. It was kind of capital, held its value long term.
Okay, gold makes sense. What else?
Well, today, people often use the S&P index, through ETFs like SPY, as a store of value, hoping for growth. Real estate is another big one. It holds value, often goes up. But Saylor flags its big drawback. It's not liquid and fungible.
Right, you can't just instantly sell a piece of a building.
Exactly. It takes time, lawyers, fees. It's clunky. And that's the issue with traditional capital, even the dollar, if you try to use it long term. The dollar loses value to inflation, right? He says nobody thinks that's the dollar for storing wealth long term, especially rich people. They don't keep huge chunks in cash.
True.
Real estate has property taxes, upkeep, local risks like rent control, maybe even governments messing with it. Gold has storage costs, security issues. It's hard to move large amounts easily. They all have these vulnerabilities, this entropy acting on them over time.
So traditional capital leaks value or is hard to manage. Where does Bitcoin fit in as digital capital? If it's not for coffee, what makes it better capital?
This is the core idea. Bitcoin is the emergence of Bitcoin as a digital capital network for the world. Its job isn't daily spending. Its power is as a superior long-term store of value. He gives this great example. Buy 1 Bitcoin for your 3-year-old granddaughter. Put it in cold storage, totally offline and safe.
Okay.
His projection. In 60 years, that 1 Bitcoin could be worth $50 million, maybe $100 million. And think about it. No property taxes, no rent control, no leaky roofs, no bank counterparty risk. You can send it anywhere instantly.
It avoids all those physical world problems.
Precisely. It's purely digital, perfectly scarce because of the CUBs, censorship-resistant, easily divisible, globally transferable. It's designed, in his view, to be the most efficient way to hold and move value across time and space without that decay or friction. Pure digital capital.
That's a powerful concept. So if it's this ultimate digital capital, how does he talk about its risk-free rate? Because 29% a year doesn't sound risk-free in the way we normally think of, say, a government bond.
Right. He's using the term very specifically, maybe even a bit provocatively, relative to his strategy. For him, that projected 29% ARR is the baseline return he expects from just holding Bitcoin, which he sees as the best capital asset. So relative to holding Bitcoin, that 29% is his benchmark risk-free return.
Ah, okay. It's his personal benchmark.
Exactly. So when someone pitches him another investment, he says, look, I'm getting nearly 30% basically risk-free just holding Bitcoin for 20 years. Your idea needs to beat that, plus account for its own risks, plus be tax efficient. And he finds most things just don't stack up. It sets an incredibly high bar.
It really does. It flips the script entirely. And he uses that analogy, the flat land versus the speeding train, to explain this difference in perspective, doesn't he? Can you walk us through that?
Yeah, it's a great one. He says the dollar is like flat land. If your wealth is mostly in dollars, you have zero AR relative to the dollar itself and zero volatility. $1 million today is $1 million next year, nominally. You're like a stationary person in flatland.
Just standing still.
Right, a pedestrian. And from that flatland, you look at something moving fast, like Bitcoin, and it looks scary. You might even think my money isn't an asset because it's not going up, ignoring inflation, eating away at it.
Okay, that's the flatland view. What about Bitcoin?
Bitcoin is the speeding train. Historically, it's gone up, say, 60% a year against the dollar, but it also has 60 volatility big swings. So you're on a speeding train going 60 miles an hour, and there's a flywheel spinning 60 RPM. There's rapid forward movement, but also rapid fluctuation.
Some momentum and turbulence.
Exactly. And the person on the Bitcoin train, if they understand the long-term direction, they don't freak out about the spinning flywheel, the volatility. They focus on the speed, the ARR. He calculates that $1 million of Bitcoin is going to double every 18 months, based on that 60% historical rate. Double it 4 times over 6 years. $1 million becomes 16 million, potentially.
Wow.
It's just a totally different financial reality from the person standing still on the flatland. They see the world and assets completely differently.
That perfectly leads into the next point, the difference between volatility and actual risk. Saylor often quotes Howard Marks, right? Volatility is not risk, volatility is volatility. How does he apply that to Bitcoin?
Yes, that's absolutely central. He's saying the price swings, the ups and downs, that's just movement.
Yeah.
It's not the same as permanently losing your money. He uses another analogy here. A carnival ride, like a roller coaster.
Okay.
The ride itself is volatile, right? It goes up, down, sideways. That's the nature of the ride. That's Bitcoin's price chart. But the volatility, the bouncing around, isn't the risk.
So what is the risk then, if the ups and downs aren't it?
The risk, he says, is if you fly off the roller coaster or if the merry-go-round stops working completely. For Bitcoin, the fundamental risk is an extinction-level event.
Extinction level, like what?
He gives these almost sci-fi examples, but the point is serious, like space aliens come down and take your Bitcoin. Or, more realistically perhaps, some evil genius creates a cyber virus that destroys the Bitcoin network instantly, irrevocably.
Okay, so catastrophic failure of the whole system.
Exactly. It's not about a price drop. It's about the network itself ceasing to exist or being fundamentally broken. He compares it to everyday risks. The risk of flying isn't turbulence, it's the plane crashing. The risk of crossing the street isn't stumbling, it's getting hit by a bus. The risk of eating isn't just, eating, it's eating poison.
It's about trusting the underlying system won't just disappear.
Precisely.
Yeah.
And he views the chance of that kind of extinction event for Bitcoin as incredibly low. So for him, the risk of holding it is tiny compared to the risk of not holding it and missing out on the upside.
That reframes risk entirely. Okay, and he ties all this together with this big metaphor, the economic physics one, the mountain lake and the waterfall. Let's unpack that. What's the lake?
The lake is huge. It's global capital. He imagines this mountain lake holding 500 trillion gallons of water, representing $500 trillion of wealth worldwide.
Wow, and where's that capital now?
Right now, it's sitting in real estate and currency and sovereign bonds and corporate bonds and artwork and equity. But crucially, he sees a lot of it as being stuck in high-energy states.
High energy states. What does that mean in practical
It
terms?
means it's in assets that are inefficient, decaying, or vulnerable. Think money tied up in a company in Africa that's going bankrupt, or real estate in Cuba, Venezuela, Nigeria, where value can evaporate overnight or be hard to access, or even just a warehouse that's crumbling.
Stuff that's subject to problems, basically.
Yeah, subject to entropy and inflation, impaired by war, chaos, competition, hurricanes, COVID. Capital is constantly fighting these forces that erode its value or tie it down. It's like water sitting high up, vulnerable.
Okay, so that's the lake. Then there's the waterfall coming down from it. What's that?
The waterfall is the performance and the volatility of Bitcoin. It looks turbulent. And this is where perspective matters. A tourist sees the crashing water, the chaos, and hates the volatility. They don't get why it's flowing so fiercely.
It looks dangerous.
But an engineer, like Saylor, sees himself, understands the physics. They know why the water is flowing.
Now, what is the physics? Why does it flow?
Simple physics, really. The sun shone on the ocean, water evaporated, clouds formed, wind blew, rain fell on the mountain, collected in the lake. Now it flows downhill because of gravity. It's moving from that unstable high energy state to a lower energy state, a more stable, efficient place. That pull is what he calls economic gravity.
Okay, so capital naturally wants to flow from less stable assets to more stable ones.
That's the idea. And Bitcoin, in this metaphor, is the hydroelectric plant.
Ah, capturing the energy.
Exactly. It's capturing that energy as capital flows from those inefficient, high-energy state assets downhill towards Bitcoin, which he sees as the lower energy state. It's economic mass flowing to a more efficient state, like steam condensing to water, then ice releasing energy. It's not random, it's physics. The reason Bitcoin's price goes up, he says, is not an accident. It's this inevitable flow.
That's a powerful image. So the turbulence, the volatility in the waterfall, that's just a byproduct of this massive energy transfer.
Precisely. He argues the volatility is a feature, not a bug. It happens because Bitcoin is, as he puts it, the most useful thing in the world from a capital market point of view. Its very utility causes the volatility.
How so? What's the connection?
Because it's this completely open 147 global capital market that allows for insane leverage and speed. He gives this example. Someone panics during a missile crisis on a Saturday night, makes a $10 billion short bet levered up 100 to 1.
Wow.
Then Sunday morning, things look better. They go long, reverse the trade just as fast. Bitcoin is the only asset where you can sell $1 billion of it in a minute at 100 to 1 leverage, and you can buy $1 billion back in a minute.
You definitely can't do that with apartments or paintings.
Exactly. If you could trade Upper East Side apartments or Picassos like that with that speed and leverage globally, they'd be more volatile too. People reacting instantly, emotionally, with huge leverage that creates massive swings. So the volatility comes from its strength, its liquidity and accessibility, not weakness. It's a feature.
Okay, this really ties it all together. So if this economic physics is real, if capital's flowing like this, what's the bottom line for Saylor? What's the only thing that really matters?
For him, the only question that matters is whether you believe the engine will keep running. Do you buy into this economic physics? Do you trust that this gravitational pull of capital towards Bitcoin will continue?
And if you do believe that, what is the actual risk?
Then, he argues, the real risk isn't holding Bitcoin, it's missing it entirely. All the noise, the price swings, the news that's just static if you believe in the underlying flow. The real danger is being stuck on the flat land while the speeding train of capital relocation pulls away.
So let me leave you, our listener, with this thought to chew on. If Saylor's right about this economic gravity, this flow of capital to a lower energy state, what other high-energy assets might be out there, maybe even in your own portfolio, that could be vulnerable to this pull? And how does reframing volatility as a feature, not a bug, change how you look at financial opportunities and what you consider truly risky?
Yeah, it's a fundamental rethink, isn't it? We've gone from Bitcoin as maybe a wild gamble to Saylor's view of it as this core digital capital asset, driven by deep economic forces, and understanding that volatility might just be the price of admission, not a sign the ride's about to break. That's key.
Absolutely. If this deep dive gave you some food for thought, maybe helped clarify some things, we'd love it if you give us a like, or even better, leave a comment with your own perspective.
Yeah.
And please share this with somebody you think might find it useful.
And definitely make sure you're subscribed to the deep dive. We've got more deep dives coming up just for you.
Yes. And for those daily nuggets, the latest insights, expert predictions in the crypto and Bitcoin space, you should definitely follow What Bitcoin Taught Me. They're on Twitter, X. Nostr, Bluesky, Threads, Instagram, Facebook, LinkedIn, basically everywhere.
Check them out. Thanks for tuning in, everyone.
Yeah, thanks for joining us on the deep dive. Catch you next time.